All right, let's get right into it. This is the U.S. market analysis for April 2nd, 2026. We're going to break down exactly what's behind the latest market moves.
Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
This video presents a direct informational narration of the source document.
Okay, and just a quick but very important heads up before we dive in. Everything you're about to hear is for informational and research purposes only. It is not investment advice. Investing has significant risks, so please always make sure to do your own independent research. We have the full notice up on the screen for you.
So here's what we've got on deck today. We're going to kick things off with the geopolitics that are really shaking up the market. Then we'll look into some really weird anomalies in the prediction markets. After that, it's the labor market and AI's growing role. We'll also review how the big institutions are positioned, analyze specific sectors and stocks, and wrap it all up with a strategic outlook and a look at seasonality.
All right, first up, geopolitically driven dislocation. And really what we're seeing is that the market is being driven by headlines, not fundamentals. The big story, of course, is the escalating tension between the US and Iran. It's creating this double agent environment where one piece of news says one thing, the next says the opposite. And it's causing these huge swings that are testing absolutely everyone.
So let's just walk through the roller coaster that was April 2nd. The day started off pretty grim, a real risk-off feel, right after the president talked about taking hard measures. But then, out of nowhere, we get this dramatic mid-session reversal. All four major indices clawed back their losses. Why? Because Iran's official news agency hinted at de-escalation. But just when you thought it was safe, the day ends with reports of a joint US-Israel bombing, and Iran immediately vowing to retaliate. So uncertainty just shot right back up.
And that initial escalation at the start of the day, well, it knocked the S&P 500 down 1.2% right at the open, as you'd expect, with everyone just piling into safe haven assets.
Okay, now for something really interesting. Section 2, Prediction Market Dislocation. We're talking about platforms where people bet on future events, and they are flashing some serious warning signs. It seems some actors out there might have some, let's call it, information advantage. Get this. On-chain data shows there are these specific, coordinated accounts that are just uncannily good at forecasting military actions that haven't even been announced yet. Their overall hit rate is 83%, but when you zoom in on bets related to US-Iran actions, that number skyrockets to a 93% hit rate, and we're talking cumulative profits of somewhere between $1 and $2 million.
And this isn't just a fluke, there's a clear pattern here. You can see it in the review of these abnormal cases. Back in October 2024, a huge bet goes down just hours before an Israeli retaliatory strike is announced. Fast forward to June 2025, same thing. A big position is taken right before a US airstrike on Iranian nuclear facilities. And then just recently, on February 28, 2026, a bet placed right before hostilities kicked off pulled in nearly $300,000 in profit. So you can bet experts are taking a close look at this. A finance professor from the University of Georgia, who used to be a CFTC advisor, put it pretty bluntly, and I quote, "Such persistent precision either reflects luck that probability theory cannot explain or, with high likelihood, insider trading."
And all of this tension is reflected right there in the market odds. On Polymarket, the implied probability of a ground war is now sitting at 66% for before the end of April. And it's at a staggering 75% for before the end of this year.
Okay, let's shift gears now and talk about the broader economy. Section 3, Macroeconomic Data Assessment. Specifically, we're diving into labor resilience and AI. The latest labor market data for March was, well, it was a bit of a mixed bag, and it's definitely sending some confusing signals to the Fed.
So let's look at the numbers. The Challenger layoff data showed 60,600, which was actually better than forecasts. Initial jobless claims also dropped to 202,000. Continuing claims were right in line with expectations at 1.841 million. So what's the big picture here? The takeaway is that the job market is still surprisingly strong. And, a strong job market could mean inflation stays sticky, which might just force the Fed to keep rates higher for longer.
But if we dig a little deeper into those layoff numbers, something really stands out. The growing impact of AI. Of those 60,000 layoffs, AI was directly cited as the reason for 15,341 of them. That's 25%, a full quarter of the total. And analysts are saying, look, this isn't just a temporary recession thing. This is a real structural shift.
companies are actively using AI to become more efficient and juice their profits.
Okay, so with all this chaos and uncertainty swirling around, how are the big institutional players positioned? This brings us to Section 4, Institutional Positioning Review. And spoiler alert, it was a dark moment for funds. For long/short strategies, March was just brutal. In fact, it was the worst breakdown they've seen since October of 2022.
And this wasn't just a US problem, the pain was felt globally. According to Goldman Sachs' prime brokerage data, on an asset-weighted basis, Asian hedge funds got hit the hardest, down 7.3% in March. European funds weren't far behind, down 6.3%, and US hedge funds were down 4.3%.
So what was driving this? A huge part of it was just extreme short selling. The ratio of short sales to actual purchases hit 7.6 to 1. That is a 13-year extreme. Now, this tells us something important. Institutions weren't dumping their long-term holdings. Instead, they were aggressively borrowing stocks to short them, basically as a hedge against tail risk. But this creates a dangerous setup, right? When a trade gets this crowded on one side, any little piece of good news could trigger a massive short squeeze, forcing everyone to buy back their shares at the same time and sending prices soaring.
All right, let's drill down a bit further. Section 5, Sector and Stock Analysis. We're going to look at where all this crowding is happening and check out some key technical setups.
So you can really see that defensive posture in the sector flows. The most heavily shorted sectors were industrials, financials, and interestingly, information technology. And where was the money going? The net buy sectors were the classic defensive plays: consumer, healthcare, and energy. Now, even though tech was heavily shorted, it feels more like a rotation than a full-on abandonment. And that, again, just sets the stage for a potential sharp rebound driven by short covering.
Let's get into the weeds with a few specific stocks. First up, Tesla. The key support level everyone's watching is 315. Think of that as the floor. On the upside, you've got resistance, or a ceiling, around 380, and then 420. Now for AMD. It's all about that 200-day moving average. That is the critical support line. If it can manage to break and hold above 222, the chances of it going back to test its old highs go way up. And finally, TSM. This stock is just showing incredible strength. The support to watch is 310, with resistance in that 340 to 351 zone. If it can clear that, we could be talking about a whole new valuation range.
And that brings us to our final section, number 6, Strategic Outlook. We're going to pull everything together, looking at the JP Morgan framework and seasonality. So what's the big picture here? It really feels like the market is entering a consolidation phase. You might hear traders call it using time to earn space.
Looking at the core strategy from JP Morgan, they're pricing a bottom support zone for the market right around 6,100 to 6,150. The topside target in their strategy is up around 6,800 to 6,900. And, adding a little fuel to that bull case is seasonality. April is historically a pretty strong month for stocks. So the thinking is, as long as we don't have some kind of major systemic crisis, the market is probably going to keep climbing this wall of worry. The strategic advice here is to stay neutral and maybe use that short squeeze potential to pick up some high-quality stocks when they dip to key support levels.
And to close, we must present the final professional risk disclosure and important notice. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, broker-dealer, financial planner, or fiduciary. No advisory or client relationship is created by the publication or use of this document. Investing and trading in financial markets involves substantial risk, including the possible loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate significantly and unpredictably due to market conditions, macroeconomic developments, policy changes, liquidity shifts, and unforeseen events. All market views, analyses, and discussions are provided strictly for informational and educational purposes. They do not constitute trading instructions, portfolio management guidance, or any form of guarantee regarding future performance or outcomes. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Readers are responsible for conducting their own independent research, verification, and due diligence, and for evaluating whether any strategy or investment is appropriate in light of their personal financial situation, objectives, and risk tolerance. Past performance and historical analysis are not indicative of future results. Market conditions may change rapidly, and information contained herein may become outdated without notice.